For a century, every time there's a major conflict, the headlines just scream, sending these waves of fear through the markets. And if you're an investor, it forces you to ask one of the toughest questions out there.
I mean, it seems like it should be a simple question, right? You see this terrifying news, and your first instinct is that the markets are just going to tank. But when you actually look at the history, well, it's way more complicated and honestly a lot more surprising than you'd think.
Just look at this. You have two massive world-changing crises, and they lead to completely opposite outcomes for investors. In 1962, the world is on the brink of nuclear war during the Cuban Missile Crisis, yet a year later, the S&P 500 is up an incredible 32%. Then, fast forward to 1973, the Arab oil embargo hits, and the market absolutely collapses, down 36%. So, what on earth is going on here?
Well, here's the key idea, and it comes from some great analysis by TAM Capital. They say the lesson isn't that war is bullish or bearish. The real secret is understanding that the market can handle these shocks unless the conflict messes with what they call the macro plumbing of the economy. And that one idea, that's the key to the whole puzzle.
And this chart just says it all, doesn't it? When you zoom way out and look at the last 100 years, you see everything. The Great Depression, world wars, nuclear standoffs, terrorist attacks. But through all that chaos, the underlying engine of the U.S. economy and the power of compounding has just been relentless. Most of these huge, scary shocks were just bumps in the road on a long journey up.
The data really backs this up. If you look at all the major armed conflicts since World War II, the S&P 500 was actually higher 1 year later 73% of the time. Think about that. The odds have overwhelmingly been in favor of a recovery. And, a lot of the time, a pretty quick one at that.
So, this is the big question, right? We need a way to tell the difference between a temporary scare that we should ignore and a real, genuine threat to our portfolio. And the answer isn't in the news headlines, it's all about that economic plumbing.
Okay, so what exactly is this macro plumbing? Think of it like the pipes and wires of the economy. It's the real-world stuff that actually matters. The global supply of oil, the inflation rate, what the Fed is doing with interest rates, whether banks are lending money, and a country's ability to actually make things. When all that is working, the market is tough. When those pipes get clogged, that's when you've got a serious problem.
So this lets us put conflicts into three basic buckets. First, you have your headline wars. These create a ton of fear, a quick dip in the market, but the actual plumbing is fine, so things bounce back. Second, you have energy wars. Now, these are a much bigger deal because they directly hit the plumbing by causing an oil shock, which then fuels inflation. And third, the ones you really have to worry about, systemic macro wars. That's when a war hits at the worst possible time, like when you're already in a recession or a credit crunch. That's the perfect storm.
And you can see this whole framework play out perfectly when you look at the data. See that giant red bar for the 1973 oil embargo? That is a textbook energy war, a direct hit to the plumbing that caused a deep, painful bear market. But now look at all those blue bars. The Cuban Missile Crisis, the start of the Iraq War, even more recent conflicts. Those were headline wars. The market got scared for a bit, but the plumbing held up and stocks recovered.
All of this makes you step back and ask an even bigger question. Why? Why has the U.S. market specifically been able to take so many punches over the last 100 years and keep on going? What makes its plumbing so strong?
Well, it really comes down to this kind of economic armor. First off, it's the world's biggest economy with the deepest financial markets. When things get scary, money actually flows to the U.S. dollar for safety. It's a powerhouse of innovation. And this is a huge one. Since 2019, it's been a net energy exporter, which means one of its most critical pipes is now pretty well insulated. And finally, you just can't ignore geography. Its industrial core is protected from the kind of direct damage you see in other parts of the world. Okay, so what does this all mean for you? It gives us a really simple playbook. If you can identify that a crisis is just a headline war, history tells us the right move is to not panic sell into the noise. If it's an energy war, your focus has to change. You need to be watching oil prices and inflation numbers like a hawk. And if you find yourself in that rare systemic macro war, that's when it's time to play defense, reduce risk, and protect your capital. And look, this isn't just some old theory from a history book. We saw it play out very recently. When tensions with Iran flared up, the market didn't have a broad, headless panic. The S&P 500 barely moved, but crude oil, it jumped. The market knew exactly what to worry about. It priced the risk through the energy channel, through the plumbing.
So really, it all boils down to this. The next time the headlines are flashing red and everyone is panicking about a new global crisis, you've got a choice. Are you going to get swept up in the fear and the headlines, or are you going to calmly check the gauges on the macro plumbing? Because history tells us again and again, that's where you'll find the real answers.